Gold, silver, and copper. These three metals continue to be red-hot topics around the world because of their breathtaking rallies over the last year. And rightfully so. These three tell us so much about fear, inflation, and economic growth. Gold is like the world's insurance policy. Silver, well, it's gold on caffeine. And then we've got copper, sometimes called Dr. Copper, because of its ability to diagnose the global economy and the global health. So what's happening for years now is that central banks around the world, such as the RBI in India and the PBOC in China, continue to hoard on gold. And in spite of a 40% drop in silver prices over the last 3 weeks, silver demand continues to surge as the world goes green. On top of that, copper is facing a potential supply deficit as AI data centers and global infrastructures demand more power than ever. So the real question many people ask is, which one should you own? Is one better than the other? And if so, how do we actually buy them? And that's exactly what I'm going to be breaking down for you guys in this video today. But before we do that, if you find these videos helpful, don't forget to hit that subscribe button and the like button. It really helps massively. I start with the most popular metal that everybody knows of, gold. Gold is not exciting. It doesn't really pay dividends. It doesn't create cash flow. It just sits there. But that's the point. Gold is basically financial insurance. One of the more popular reasons for investing in gold is to preserve purchasing power, especially during uncertain times when we don't know the direction the world is going to go in. This could be because of geopolitical shocks, such as wars, or it could simply be a hedge against inflation. The bottom line is that ultimately gold tends to attract capital because investors want to feel safe, which is exactly why it's called a safe haven asset. Now here's something people often miss. Gold isn't just something that retail investors such as ourselves buy. Central banks buy it too. When institutions across the world increase their gold reserves, that's not speculation. That's long-term strategic positioning. Governments and institutions don't simply buy gold because of hype or because everybody's buying it. They do it as a store of value. So the moments when gold really tends to shine is when inflation is high or there are geopolitical stress around the world, when interest rates fall, or even when there's currency weakness, which is exactly what we're seeing with the US dollar over the last several months. It's there for protection. And even though gold has rallied over 100% over the last year, it's nowhere near as explosive as silver is, which is exactly what we're going to talk about next. Now, even though silver is very strongly correlated to gold, it's half monetary, half industrial. It often behaves like gold as a safe haven asset, but it's also behaving like a growth asset because of the demand that's powering its recent rally. And this is where it gets really interesting, because silver isn't just a safe haven asset, but it actually has a material use case. That use case is only going to increase as the world continues to go green. We're talking about silver being used in EVs, in solar panels, in electronics, and even in semiconductors. Ultimately, it doesn't matter that silver prices dropped over 40% in the last 3 weeks, because if the world continues to go green, and it probably will, silver is going to win in the long run. So if renewable energy adoption continues to accelerate, so will silver prices. But it's a two-edged sword, and that's the warning. Silver is far more volatile than gold. It's a high-risk, high-demand asset. Like I said earlier, silver is basically gold on caffeine. If gold moves up 5%, silver might move up 15%. But if gold goes down 10%, silver might drop 40% as it did over the last month. So if the goal here isn't just to protect purchasing power, but to also invest in something that behaves like a growth asset, that's where silver can be a better alternative compared to gold, at the expense of higher volatility. Silver tends to do better than gold when the economy is expanding and when investment continues to flow into the green energy movement. Now let's talk about copper. Copper is not money, at least not in the way that gold and silver are. Copper is all about infrastructure. It's used in power grids, constructions, AI data centers, electric vehicles, basically everything around us. Copper prices often reflect the health of the overall global economy, which is why it's often called Dr. Copper. If copper is rising strongly, it usually signals that there's economic expansion, infrastructure investment, industrial demand, and right now another layer, AI. AI runs on data, massive amounts of data. And in order for these AI data centers to exist, we need massive amount of electricity. All of this requires copper. At the same time, mine production continues to struggle to keep up, but here's where things get a little interesting. People tend to think that the demand for all the copper and the supply deficit from mines mean that copper prices are going to continue to accelerate higher. This is not necessarily true. Copper has a natural ceiling. Unlike gold, which is used as a safe haven asset, copper is used across all industries. If prices get too high, manufacturers are automatically going to look for substitutes or replacements. And one of the main alternatives out there is aluminum. It's cheaper and it's lighter, and in many cases, it can replace copper. That substitution essentially puts a cap on how high copper prices can really go. And so it's not really a moon asset the way many people think about. As a result, when many people look into investing into copper, they're not talking about holding copper in the way they hold gold or silver. Instead, they talk about investing in ETFs of mining companies. The bottom line is this: investing in a mining company or an ETF of mining companies essentially acts like a leverage on copper prices. If copper prices go up 5 to 10%, these mining companies can go up maybe 20%. So if there is faith in the long-term electrification of the world, instead of investing in copper, mining companies tend to be a more lucrative option for many investors. So while we understand the basic differences between these three metals, it begs the question, how do we actually own them? How do we actually buy them? And there are three different options for this. The first one is physical ownership. This means owning the actual metal. For gold and silver, this could mean physical bars or bullions, which can be bought from any reputable dealer across the world. There are pros and cons to weigh when going down this route though. First, when buying spot and physical, prices are often at a premium. Making costs, minting costs, and even profits that need to be made by the dealers often end up increasing the price of the metal. Second, one has to worry about storage. If buying large quantities of these metals, one needs to figure out exactly where they're going to store these metals. This is especially true when it comes to silver, where prices are not nearly as expensive as gold yet, and it can be bought in higher volume. However, the upside to it is, well, number one, most people feel a flex when owning some of these metals physically. The second is that there's actually no counterparty risk. The main alternative to this is to do it online, via paper or the digital method. This is probably the simplest option, and buying ETFs is the most common thing that people tend to do these days. These trade just like stocks. You can buy and sell them from your phone. They're highly liquid. It's very beginner friendly. The only thing is that you don't physically own the metal. There is a third option that has been gradually rising and becoming increasingly popular. These are apps on your mobile phones that allow you to invest in part, such as buying fractional shares, when you have lower starting capital. This is especially appealing to people who just want to start testing the waters and want gradual exposure to metals rather than jumping in all at once. However, this is also the most risky of them all, and one needs to do proper research into making sure that the apps through which they're buying these assets are reputable. Given all of this, I need to say that I am not a financial advisor. This video is for educational and informational purposes only. Investments of any kind carry a lot of risk, including precious metals. As such, it's important for you to do your own research or even consult a licensed professional if you're looking for advice. Now, with that being said, here are some of the key things that beginners need to understand. Investing in metals, even after seeing the rise that we saw over the last year, they're not get-rich-quick scheme assets. In fact, they're mostly stay-rich assets. If you're coming into this space and investing in gold and silver, hoping to double your money within the next month, you're likely at the wrong place. However, for anybody trying to build a true investment portfolio, this is likely a very important class of assets to look into. Now, if you found this video informative, please don't forget to hit the like and the subscribe button. I'll see you guys in the next video.